I think we rely heavily on outside people that know that area. And I mean specifically, let's say on the insurance or on the workers' compensation side. In the food business, one of the highest risk areas is sanitation and health safety. And so that one, having been in the business, I knew how paramount that subject is. And we've always wanted to be ahead of the curve, if you will. I think we were probably, for example, using disposable gloves years before they were required by the health department. We just knew that was coming. We sensed it, we saw it, and we just said, let's just do it. It's the smart thing to do. And so we're pretty obsessive about everything that has to do with that aspect. We have checklists coming out our ears with checking food quality and temperatures and dates and those kind of things that behind the scenes most guests don't see that. So that's the one that I think we're the most concerned about, and I think we manage that one internally really well.
Northern Initiatives is committed to entrepreneurs like you because you are the people who are creating jobs and enabling the communities of our region to thrive. After completing this module, you'll be able to identify the common risks associated with a small business, identify the external and internal factors which affect risk for a small business, and develop, implement, and evaluate a risk management plan for your business.
Risk management applies to many aspects of a business. Your business is subject to internal risks, weaknesses, and external risks, threats. Generally, you can control internal risks once you identify them. However, external risks may be out of your control. Not all risks come from negative sources. Risks may also come from positive sources or opportunities. Expansion and growth are opportunities, but they also bring additional risk. The ultimate goal is to minimize the effects of risks on your business. Minimizing and controlling the effects of risks can improve and maintain business cash flow. The continuation of cash flow creates stability for the organization and helps credit relationships remain intact while building additional credit. The rewards of risk management are all linked together. Good cash flow leads to stability, which leads to good credit, which leads to longevity. Think about your own business for a moment. Starting a new business is a positive opportunity, but also a risk. We all have goals of growing our businesses on a small or large scale. Growing too fast or too large is a risk that is a common pitfall for small businesses. As business owners, we're surrounded by risk factors each day. Some of them we can control, others we cannot, and the risks are both internal and external to our companies. Let's start by examining the internal risks a business may face. Internal risks. The human component of your business is a source of risk. Think about these possible human risks to your business. A business owner, family member, or employee may be ill for a day or be unable to work for months. The death of a person involved in a business poses a risk to continued operations. As the business owner, what is your fallback if you become ill? Most businesses want to have an honest working environment, yet theft by employees and employee fraud are major risks. Time card fraud is a risk. Diverting funds to fictitious accounts are accounting risks. If you do not understand how to interpret your financial reports, how can you protect yourself? Unhappy employees can cost money through negligence or through willful acts. For example, customer service is a big risk. Employees are the face of your company. Lack of training or clear expectations is also a risk. How do you contribute to positive employee morale? Small businesses often hire friends and family when they are first growing. For example, spouses sometimes take care of the bookkeeping for a small business, but what happens in that relationship if and when mistakes are made? Managing reasonable expectations and boundaries in those relationships is important from the beginning. Older equipment may run slower or require more maintenance than new equipment. New equipment may require adjustments to work with older equipment. Worn parts may cause damage or cause company vehicles to break down. What would a non-working delivery van cost a business for one day? How long could you operate a bakery when the main oven goes down? What would the impact be on your office if your accounting computer died and took the backup with it? Downtime from physical damage or outdated systems may slow business profits. Most businesses rely on a computer system to process credit cards. These systems are risks to continued business when they're not working, especially if no backup plan exists. Another source of risk might be the physical plant of your business. Breaks in phone lines and other utilities are risks to a business. Injuries and damages may be caused by your business, or your business may receive damage. For example, a storm may cause damage to a business, or a business may cause damage by selling a faulty product. Either way, injuries and damages come with a cost. There are operational risks such as waste, especially in manufacturing and restaurants. It's expensive to have your raw material go to waste because of careless handling by an employee, or when inferior quality product from a supplier arrives at your business and goes unchecked. Cash flow is the lifeline of a business. When unexpected costs affect the ability of a business to meet monthly expenses, or when credit lines are lost, a business may fail. A plan to maintain cash flow is crucial. Even new financing has its own cost-associated risks. The risks can include the following: appraisal costs, environmental reviews, closing costs, costs for points to buy down rates, deposits placed on hold as collateral. Are you prepared? What other internal risks can you think of for your business? Now we will examine the external risks that may affect a business. Competition can be tough, and market changes can make life for your business tougher if you're not prepared. Consider these risks: rent increases, business seasonality, changes in competition, employees may leave. Business seasonality is common in regions that are dependent upon tourism or a particular kind of weather to allow their business to flourish. Seasonal businesses can be much harder to manage because you have a compressed amount of time to generate sales for year-round cash flow, make critical business decisions, and hang on to quality employees when you're unable to offer full-time year-round employment. Market changes may require businesses to adapt. Competitors advertise sales, wholesale costs go up and down, and oil and gasoline prices fluctuate, which affect your costs and those of your vendors. Vendors can change their prices without notice, putting a squeeze on your profit margins. Are the people you do business with credit risks or credit worthy? Employees may leave to go to a competitor's shop, taking loyal customers with them. While competition cannot be controlled, you can at least know what they're doing. What products are they carrying, and how are they priced? How do your prices compare? Is your quality the same as theirs? Are you losing sales to them? Your environment is more than the space you rent or buy. What happens around your business affects it. Here are some examples of environmental risks. Federal, state, county, and city laws and ordinances can change, such as tax laws or licensing requirements that impact your business. Weather and natural disasters can shut down a business for a short period or close it due to loss of power or facility. Changes in the community may be the result of progress, such as road improvements that, unfortunately, reroute traffic away from your business. Your community may change as the needs, age groups, spending habits, and incomes of the population change. How do you manage these kinds of risks, or at least control its effects? Even complacency is a risk. Complacency comes from being comfortable. Your business may be successful and has been for a while. You may be comfortable with the hours you're working, but you may miss opportunities for growth because you don't want to expend the extra effort. A business owner can either plan for change or react to it once it arrives. Now, multiply the effect of complacency, because complacency also happens to employees. Now, thinking about your business, what are the biggest external risks? What strategies do you have in place to guard against them? One of the most important investments you can make in your business is creating a business plan, especially when identifying risks. Creating a business plan will help you assess areas of risk that could potentially impact your growth and the ability to continue business. A business plan isn't something to create and set aside simply to be used later to obtain financing. Once completed, the business plan will become your guide, just like a map. It should be a living, breathing document that's referenced on a monthly or quarterly basis as you review your business goals and accounting trends. The continuation of your business in the event of any risk should be noted in your plan. What could halt, slow, or affect the profit of your business? List these risks, rank them in importance, and identify potential costs. Identifying and assessing risks is something that will require time and should be revisited periodically. Be sure to schedule time in your calendar and get help from outside sources in identifying areas of risk. Once risks are identified and evaluated for their potential consequences, they should be measured by how they affect earnings, cash flow, and business operations. A good example is water damage. A business that flooded may be cleaned up, reopened, and continue operations. But the expenses for cleanup put a strain on the budget for months to come. Lost income is not the only thing to consider. For example, customers may move to businesses that did not flood and not return to your business. This customer migration may require new advertising or new products to renew interest. Scrutiny of all the costs associated with a risk is important for measuring risk. Northern Initiatives recommends you implement a risk management checklist as a system to organize the analysis of your business's strategic, operational, financial, and market risk. Here are items to consider when developing your business's risk management checklist. Part of your risk management checklist is to develop your annual budget, review your business plan, develop and review your business goals, as well as your 3-year strategy. Setting up the frequency of these activities and setting aside time in your schedule to focus on these items will increase the probability that they will be achieved. Your operations manual should include a business continuity plan to detail how business will continue if a disaster or emergency occurs. The plan should provide steps to take for short and long-term situations. For example, if your business is unable to operate in its present location, is it possible to use another? If so, your plan should list the steps to take by job position for reestablishing operations at the backup site. Tasks to complete for business continuity include: identify the critical functions of your business, create a set of standard operation procedures for completing functions, train staff on your continuity plan, conduct trial runs and periodic testing of your systems, back up your computer systems, and keep copies in a secured off-site location. Discuss plans with software or operating systems providers, as they may be able to assist in disaster recovery plans. In your continuity plan, include the following: staff members' duties, staff members' work locations, contact names such as email addresses and phone numbers, vendor, utility, and emergency phone numbers, employee notification phone tree. For example, an owner calls managers and managers call their department staff. Keep a copy of your continuity plan in a place where your managers and staff can access it easily. Special risks are connected to information technology, or IT systems. Create a technology policy and review schedule for your business. Some IT risk prevention tips include: set up protocols for user access, firewalls, antivirus, backups, and passwords, and review them regularly. Review your systems for redundancy and exposure in case of disaster or failure. Review status of systems and plan for upgrades to support your business. Conduct audits of IT systems. Your employees are important to the success of your business. Review these tips for managing your employees. Your type of business might necessitate pre-employment screening, which is important for legal and insurance purposes. Many business credit reporting agencies and human resource service providers will help you with screening and background checks. Provide job descriptions and lists of duties. Communicate job expectations and any job expectation changes to your employees. While it's important to separate duties, cross-training your staff helps to ease costs in the event someone leaves or the business is short-staffed. Provide performance evaluations. Employees should expect evaluations to enhance their performance. Provide feedback and allow them to comment about their jobs. Reward performance. For some types of businesses, rewarding performance may be appropriate when employees achieve business goals such as sales. Ask for feedback when employees leave by conducting an exit interview. This conversation can reveal valuable information for you as an owner as well. In addition to developing policies and reviewing them annually, it's also important for operations risk management to review insurance policies, contacts, and succession plans on an annual basis. Your type of business might need an internal audit, which might include inventory. Having a set plan for record keeping and a schedule for record retention is important to ensure that you have legacy documents available if you need them. Financial risk exists in every business, although some of the intricacies can differ among different types of businesses. In any business, setting up a system of checks and balances is an important strategy for mitigating accounting and cash control risks. Potential for fraud or theft can exist without a separation of duties. The employee who accepts cash or payments, processes the work, deposits funds, and reconciles the related account may be tempted to commit theft. Implement a process to provide regular oversight of company-issued credit card use. Consider setting up an audit trail with one person accepting and processing payments, another preparing the bank deposit, and perhaps another for reconciling statements. For all 3 steps, amounts should be verifiable. Cash payments and arriving mail should be logged or verified by 2 people. Each person should count the cash in the presence of the other. This procedure sets up accountability and provides a record of the activity. Job duties should have differing levels of authority. Some duties may require recorded supervisor approval. For example, the server at the restaurant may need approval of the shift manager to void the charge for a poorly served meal. Issuing credit for returned merchandise may require supervisor approval above a certain dollar amount. Conduct periodic audits of cash to ensure that it balances with all income records and bank statements. Surprise audits should be done at least quarterly and at different dates in the month. Monthly budget projections should include a reserve amount for each month. This should provide a cushion to cover payments. An accountant may assist you in determining the amount to hold for additional cash flow based on your financial statements. Audits should be conducted on payroll systems. Check project time cards against job sheets for appropriate time submission. Compare time cards to payroll ledgers and payroll ledgers to the payroll account. Once your financial checks and balances plan is in place and you're practicing the plan on a daily, weekly, monthly, and quarterly basis, consider some additional items on your checklist that requires your oversight and attention. Understand that cash flow plans are not glimpses into the future. They're educated guesses that balance a number of factors, including your customers' payment histories, your own thoroughness at identifying upcoming expenditures, and your vendors' patience. Watch out for assuming without justification that receivables will continue coming in at the same rate they have recently, that payables can be extended as far as they have in the past, that you've included expenses such as capital improvements, loan interest, and principal payments, and that you've accounted for seasonal sales fluctuations. Your interim financial statements will tell you a lot about your financial risk. Monthly and quarterly reports are not as authoritative as your annual financial report, but are readily accessible for your ongoing decision-making processes. Key financial ratios such as debt to worth, quick ratio, and current ratio should be determined. It's wise to compare your ratios over time. Are they improving over time or deteriorating? The debt to net worth ratio of a company or individual is a comparison of how much debt the entity is carrying compared to how much net worth it has. For example, a company that has $50,000 in debt with $100,000 in net worth has a 1-to-2 debt to net worth ratio. Read this as, for every $1 of debt, the company has $2 in net worth, also called equity. The quick ratio informs of a company's ability to quickly generate cash in order to make payments on current obligations. The formula is cash plus accounts receivable divided by current liabilities. Inventory is not included because it takes longer to convert to cash. Ideally, this ratio should be 1-to-1. $1 of cash and accounts receivable for every dollar of current liabilities. If the top number is lower than 1, the company may need to turn inventory faster to generate more cash and/or accounts receivable. The company may want to review its accounts receivable aging to make sure clients are paying on time and accounts receivable is not growing larger due to unpaid accounts. Excess cash may present an opportunity to invest in other business assets, pay down debt, or explore growth and expansion. In a seasonal business, sufficient cash reserves are needed to pay bills during low sales months. The current ratio is a financial ratio that tests the company's ability to pay bills due in the next 12 months. It's calculated by dividing current assets by current liabilities. Current assets include cash, accounts receivable, and inventory. The current ratio is used as an indicator of a company's liquidity. The goal is for the ratio to always be higher than 1-to-1 with a target of 2-to-1. In other words, for every $1 of bills coming due in the next year, there is $2 in current assets available to pay those bills. Another item under the financial section of your risk management checklist is to perform an annual review of your banking relationship and services. Are their products and services in line with your business needs? Is the financial institution FDIC insured? You should also review and plan for tax obligations for the next year. Remember to work with your CPA for forecasting. Tax planning is a very valuable commodity so that you are able to fully take advantage of provisions and deductions that are available to you. Make sure that you review your personal credit score frequently, especially if you've put measures in place to improve it significantly. Also, review your credit lines to ensure they meet your needs while protecting yourself from overextension. Evaluating your market risk can be a challenge for some businesses. As business owners, we view our marketplace and industry through assumptions and filters because we know our market. For this reason, it's important to evaluate market risks on an annual basis in the most objective manner possible. Ask your customers how you are doing. Are their expectations being met or exceeded? In some situations, you may consider a third-party service to conduct the survey so your customers can speak candidly. Annually, you may be looking to see if your business can grow through diversification of products and services or by entering new markets. Your customer survey might reveal additional needs that you can easily meet. Growth comes with risk, but with good strategy, it can be profitable and stabilizing. Your vendors have risks too, some of the same risks you face. Relying on only one vendor may be risky for your business. You may be able to avoid problems with your vendors by following these suggestions. Have more than one supplier for products. Shop for vendors with the best price and service. Maintain relationships with multiple vendors. A multiple vendor strategy may make vendors push for more of your business, resulting in lower prices. In any event, if one vendor is unable to deliver, you'll have a backup. Annual review of costs and pricing can help your business tremendously. Knowing what your overhead and variable costs are and revisiting those agreements and contracts on an annual basis can help you optimize your capital usage. In addition, annual review of your pricing strategy can help your business grow. What products or services are high volume, low profit for your business versus low volume, high profit? Make sure you aren't setting your prices to just cover your costs. Cost-based pricing is very common, but value-based pricing can increase your customers' ability to receive better value. Remember, the rewards of risk management are all linked together. Good cash flow leads to stability, which leads to good credit, which leads to longevity. The ultimate goal is to minimize the effects of risks on your business.
I've made a couple of bad decisions in my life business-wise, but I've made a lot of good ones, and almost every single one of them has been driven by my gut and my instincts and my understanding of where we're at, where our place is in the manufacturing world, what are the opportunities moving forward. I try to stay very in tune with not just the overall economy, but our specific business by paying attention to all of the trade organizations and really being connected to the people that understand numbers and where we're going as an economy and as an industry. As long as you've got as much information available as possible when you make the decisions, I'd say that's the single best way there is to mitigate risk.
We realize the success of your business directly impacts the success of your community and its people. So we push a little harder and care a bit more because it's not profit for us, it's prosperity for all.